Hello, Andreas Bork, Investor Relations in SHEL. It's a pleasure to be on your line again. Wanted to give you an update on where we are at SHEL. We had a capital market day in March this year. It was not a revolution, but an evolution of what we said in 2023. The company is going well. We are recovering, but we are still not in top form, and therefore there is additional value to be gained. And that's what was the message at the Capital Market Day. And I'm looking forward to discuss that with you, Matt, in more detail. Thanks for having me.
Good to see you again. It's been 7 months. 7 months seems so long ago. That's what we want to talk about today. Is trying to understand the kind of global energy demand mix through, 2030, 2040, and beyond. So, particularly, how does Shell model oil, gas, and renewables? Has much changed since we spoke?
No, I don't think so fundamentally. And we do it in several ways. We have for over 50 years had a scenario team that works kind of independently of the rest of the business to not predict the future, but to create some bookends, some different pathways for the future, and allow management and the board that as input for considerations. And we have kind of three at present. One is what we call Horizon. It's a normative scenario. The world gets to net zero by 2050 because that becomes the priority of the world. Secondly, we have a scenario we call Archipelago. And that's unfortunately a little bit what we see right now, where regions and countries are focusing very much about themselves. And there we see that energy security becomes a key theme. So how can countries and regions ensure that they have energy enough and access to lower cost energy? And then the newest scenario is search, and that is looking at artificial intelligence as a real game changer in terms of something that creates additional growth in the world, but also can help the energy transition in terms of the technology that it brings and the opportunities it brings in terms of faster development of low carbon solutions. So three very different pathways, and we then look at those three pathways and say, okay, so what does that mean for our core businesses, whether that's oil products, or whether it's gas, LNG, or whether it's renewables in different shapes, biofuels, wind, solar, etc.
So talk. Okay, there's a lot to digest in there, and we'll come back to each of those kind of three strategies or thoughts, I should say. All of those seem to attach themselves to a kind of net zero future. Is that right? Is that and do you believe that net zero is achievable, or is it just a case of you understand your role within achieving that?
No, indeed, you're right, Matt. So all of it gets to net zero, but the timing is very different, and the level of overshoot is also different. The normative scenario, because it's normative, it's given that you reach net zero by 2050, and therefore it's a scenario that outlines what is required, not only on the supply side, but very much on the demand side and on the governance policy making side to get to net zero by 2050. The two other scenarios are exploratory, so you allow the pathway to develop itself, and you reach net zero, but it's not reaching net zero at a different at a specific path in terms of timing or how much overshoot you have. You allow the scenario to run out as you predicted, and then you calculate, so what does that mean in terms of climate change, what does it mean in terms of when do you reach net zero? And our three scenarios therefore sits between 1.5 degrees, the normative scenario, and the archipelago where regions are thinking more about themselves ends in 2.3 degrees, with the middle scenario, a revolution in technology through AI sitting in between. And I think there's some important messages in that. So we are very focused around net zero 2050. It's important in the debate in society. The positive message is that none of these scenarios is talking about a global warming of 4 degrees or 5 degrees, which was where some scenarios was, 5-10 years ago. So in that sense, there's some positive messages that in the bookends we see is between 1.5 degree on one side and 2.3 degrees on the other side.
Right. So you've got a balance here between your, like, and I appreciate that you've given a lot back to your shareholders recently, but you've got this balance between investor demand for profitability and an environment where I think politicians are perhaps easing off on the climate change conversation. Does that give you some leeway? Does it cause you to, question or second guess some of the strategies that you're looking at? Because it's tough out there in the markets. Full stop. You said yourself, it's kind of like an evolution for you guys, and you're talking about 2050, and I think most shareholders kind of want, well, now. So how do you balance those things up?
Yeah, and I think we have been on a journey, and we've come to the conclusion that there's a few things we will have to require, and one of them is that whatever energy solutions we want to play in, we need to have competitive advantages. So the idea of, because we're an energy company, we need to participate in all types of energy solutions, irrespectively of whether we have competitive advantages or not. Those days are gone. We need to offer something into that market. We need to offer a clear rationale why we are better at providing that energy solution than others. And secondly, we need to see a market where there's a demand and where we can make a reasonable return. And if those conditions are not there, then we will not use shareholders' money and invest into something that, will not be successful and will generate low returns on capital. And I will go one step further. If we were going to use shareholders' money, invest into solutions that don't generate good returns, we wouldn't help the energy transition either. It would not, encourage others to also invest. If anything, you will see, stranded assets, you will see impairments, and people would be more worried about doing something similar. So, those two rules, I think, is actually over long term also healthy for the energy transition.
Do you think this energy transition, do you think moving towards net zero is achievable, genuinely achievable, or do you think it's a case of it's important for you to offer energy solutions, a choice of energy solutions to the market, and others perhaps will, choose a different path? Because I think we talked last time about your thoughts on renewables in the business. Perhaps you were not necessarily as positive about the energy return on investment basis, the role of renewables, and perhaps the focus on LNG was more important to you. So this is all about choice, not necessarily trying to solve one problem for everyone.
Yeah, listen, we have a strategy we call more value, less emissions. So we want to achieve both. And we think that's absolutely possible. And we also are all in favor of an energy transition that needs to take place. No doubt about it. What we see today, though, and what we called out at our Capital Market Day was that we have some 45 billion capital employed that is generating a negative return. And then on the other hand, we have some $175 billion capital employed that is giving a very satisfactory return on capital of 15%. So we have some self-help to do. We need to fix the $45 billion that is not firing on all cylinders or not firing at all. And if you break that down, you will see that some $25 billion is in chemicals. And some $20 billion, unfortunately, sits in low carbon solutions. And we need to, those $20 billion, we need to find a way to increase the return on capital. And we believe we can do that. So it doesn't mean we are giving up, but it does mean that we are requiring a decent return on the capital. And that means we have changed our strategy somewhat in this area. In power, it's less about generating wind and solar renewable energy and more around being the intermediate between the producer of wind and solar and the customer. And that means we are investing more into flex generation, more into storage batteries, and more into technology to trade around.
Right. Okay. Again, a lot to digest there. Can I go to the technology bit? Because I think an important part of all of this is the kind of, the future planning for the company, long-term vision. Because I do want to come back into the company, but I want to talk about some of the sort of the KPIs, the things which drive you, world leading integrated energy company, and everything you've just said now in terms of understanding the need to make money. What do you think your competitive advantage is? What do you think you are trying to be that perhaps the likes of Total or BP or Aramco are not?
Yeah, so we look across the activities we have, and we look at where do we have competitive advantages, as I mentioned before. If we look at our traditional oil production business, we are in deep water. It's favorable in terms of break-even cost, and we are producing some of the lower CO2 emission barrels. If we look at LNG, we are a global leader in LNG. We think there's a lot of LNG growth in the coming 2 decades. And we believe that's good for the energy system because you can replace oil and coal. So it's not a low carbon fuel, it's a lower carbon fuel. In marketing and in our downstream businesses, we have access to more customers than anybody else. So we can provide low carbon solutions today at a higher cost. Today we see limited demand, but we think that will change over time. And then finally, we're the biggest trader. And in many ways, Shell is a trading house. And what you see in the next 30 years is that the energy system will be more differentiated. There will be more different energy solutions in the next 30 years than ever before and probably ever after. And we have a unique position in terms of being able to trade that. So whether that's traditional oil products, whether it's low carbon fuels, whether it's power, whether it's LNG, there's simply more solutions available right now over the next 30 years. And with the strongest trading capabilities among all peers, we think that is going to be a strategic advantage for us.
So when you say the market isn't there yet, but you think it will come, how do you stop yourself from, you build a product and they shall come? I think in lots of sectors that perhaps it's not the wisest thing to do. Otherwise, you're kind of incentivized to kind of create markets which are perhaps less efficient just because you sell that thing. So how do you marry that up with all of your, you spend over $1 billion a year on R&D, and you've got lots of patents out, and you talk about technology earlier. How do you get that balance between maximizing the return on one energy solution which you're invested into, and moving forward to something which is perhaps more efficient going forward?
Yeah, with discipline. So we have today capital employed $5 billion into biofuels, and it's loss making. Will it be profitable in this decade? Maybe. Will it generate a decent return? Probably not. So the appetite to then add billions of dollars into that at this point in time is not there, because we don't see that market develop in the next 5 years. Have we the right positions? Have we the right holding points? Do we have the right capabilities in terms of, I mentioned trading, but also in terms of logistic depots, tanks at customers, vehicles that can transport it, ships, pipelines, etc.? Yes, we do. So it's a market where we think we have competitive advantages, but it's a market where everybody is suffering at this point in time. And the reason for that is that the products are more expensive. And that means today that the demand is predominantly driven by regulation. And if the regulation is not creating a lot of demand, then the demand stays low. Sustainable aviation fuels. Biofuel blend into diesel and petrol. These are more expensive solutions. The sustainable aviation fuel costs 2 to 4 times more than traditional jet fuel. Airlines will not, in general, add that amount of cost to their overall large fuel budget, unless there's a regulation that they say you now have to blend in 2%, 6%, 10% sustainable aviation fuel into your traditional jet fuel. So that's what I mean by policy making. Regulation is creating a demand, because on a voluntary basis the demand is not there today.
No, so it's about economics. No one wants to eat into their margin, or have to pass it on to customers, because that will reduce. That's going to affect the whole market. So, the sustainable bit of that conversation, we need to be putting the word sustainable at the front of something. To just to help me understand it, is you say 2 to 3 times the cost, 2 to 3 times the cost to produce, 2 to 3 times the cost to purchase from it by the airlines. Which is it?
Two sides of the same coin, I would say.
Right.
So essentially, okay, that's the price, because the production cost is higher.
Okay. Interesting. What are the sort of technologies that you think will be coming through eventually? Because you've got to go to phase all of this. You can't sort of stop something when you haven't made your money back on it yet, but you know that you will. You may want to kind of rush into other kind of vertical energy solutions, but you got to time these things. You got to work out the economics. You got to create the markets. You got to change people's minds, and maybe even affect regulation. So how does that side of the business work? I get the, how does it work?
Yeah, we have a research and development budget of around $1 billion a year, of which half is going into research in energy transition in one way or another. Some of that will be around better efficiency of products that enhance efficiency, and therefore help getting a better consumptions of energy, a more efficient consumption of energy. It can be special loops that can reduce the energy consumption in AI data centers, as an example. It can be in LNG. How can you enhance the efficiency of LNG plants, and therefore need to use less energy when you cool down the gas to make it liquid, to ship it, to bring it to markets. But there will also be a lot of processes where you invest into processes around biofuels efficiency, etc. So there is a variety of of programs, including some of these further out solution synthetic fuels or direct air capturing, which we are also investing into today.
You're investing in the research, or you're investing in as a commercial entity?
No, into the research. So for direct air capturing, we have a pilot plant up and running. And synthetic fuel, we have produced synthetic fuel and we have put them on a plane. But, it took 8 months to produce 500 liters. So it's clearly not something that is commercial today.
Right. And how's the workforce transitioning or transforming in all of this? Because different sets of skills required for all this new technology. Are you having to employ more people, or is it sort of natural rotation of old and new?
It's difficult to I think give. I think it's very much case by case, but I think keep in mind that in traditional oil and gas, you will see that there is a natural decline in a reservoir, and therefore you will always have had areas where you have produced for long, and then it starts to come at the end of the lifetime, and therefore you will need to address that in terms of what are you doing with your workforce. So we have seen that in the North Sea, both in the Netherlands, in Scandinavia, and in the UK, and there you have seen a redeployment of people and a renewal of what these cities like Aberdeen or Esbjerg or Stavanger are living from, which have gone from oil and gas towards offshore wind. So they it's not a new problem, so to speak, that you need to renew your workforce over time. It's something we have seen before. And in general, by continue to focus on areas where we have competitive advantages and where we are clear around that, I think the renewal of staff is probably less than people imagine.
Okay.
But there is retraining programs that will be help to staff if they are in assets that are maturing in terms of retraining, etc. So it is an issue that is being addressed. I'm more saying that the speed of that is probably less than people imagine.
Okay. You mentioned the trading side of the business a few times, and that's very, very different because it's sort of almost arm's length from energy production. Perhaps a bit easier for people to understand as well. But if you take things like the strategic and commercial lessons learned at Rotterdam's biofuel plant, do you think you'll kind of do a Ford car? I remember back in the early 2000s, Ford said, actually, it was in internal discussion, we're going to stop making cars. We're just going to manage the brand. And they basically got rid of all the manufacturing of cars, and they outsourced that to Mexico, Brazil, etc. And they managed this car sales and the Ford brand. Do you feel, have you looked at that kind of model here, where then you don't have to deal with are you dealing with fossil fuels? Are you transitioning from fossil fuels to something cleaner? Is that possible in this sector?
Yeah, a few things. I think our trading business is very, very connected to our assets. And in some part of the business is probably a trading-led asset deployment. So trading is mainly optimization and not speculation. And that means it's grounded in assets and in flows of oil products, gas, LNG, from producers to markets. So that's how to think about it. So it's very, very integrated.
Okay.
And it needs to be. And that also means that we are not looking to become a trading house without assets. Actually, what we see in the market today is that trading houses are buying assets.
Right. Okay. And where does the margin get taken? Because you've got all these kind of verticals, these siloed revenue streams. But like if you look at the kind of technology sector, they tend to try to grab all of the margin. Well, usually in their case, offshore vehicle. At the end of the line, does the trading house capture all of the upside? Or do you think each of these commercial silo revenue streams need to be commercially viable in that sense?
No, the latter. There will be, an opportunity to enhance margin across the value stream.
Okay.
So you need to be competitive when you produce the oil. You need to have competitive refineries, and you need to have supply of products, own or third party, and a customer base where you can match the two in a way where you make sure that you pay less for the products than you sell it for. And you do that through your optimization.
Okay, so everyone's accountable. Sticking with the technology side of things and revenue side of things, I think we talked last time about public EV chargers, and that's lots of various thoughts about that and availability of those things. And how's that part of the business? And are you expecting that to be cash flow positive and stand on its own?
Yeah, again, increasingly we are looking at it as part of a very competitive mobility, so service station business, and that means we are focusing on the go market. So not people charging at home in their driveway, but people that needs to get from A to B, that needs to stop and charge, where you offer supercharging. You're offering a shop where you can get a coffee and a sandwich, and you offer that whole experience, and that is the same experience that our diesel and petrol customers have enjoyed until now, and that's what we offer to the EV customers.
Is that model going to evolve or change? Obviously, I think it's famous that the fuel is not the money making bit; it's the shop, the much more expanded offering in the shop, coffees, sandwiches, all the rest of it. Do you own the land? Are you a tenant? Are you just a brand owner? And I mean, how does it work actually? I was intrigued. Never asked you last time.
No, and there's various models. So in some cases we are the owner and we operate the facilities. In others we are the owner and a third party operates. And again, a third model is that somebody is franchising our brand, but they own the site and they operate the site. So you have all the models, and it varies both from countries and regions, but also it varies around how well known your brand is and how well established your brand is. So there are horses for courses in terms of the model, and we see across the whatever 45,000 sites, different ownership models.
Interesting. Okay. No, I always wondered how that broke down. And what about things?
But then back to Matt. Just back to the business. So the way we look at it is then how can you maximize the wallet size of a visit and your customers coming there, and that could be margins on the petrol diesel or margins on the electrons, because don't forget a EV customer would be keen to get out of your site as quickly as possible, and that means superchargers has a value to them. So you can charge a higher margin if you have a faster solution for the customer.
Okay.
And secondly, you have the advantage that an EV customer don't have to stand next to the car when fueling. So we tend to see that the wallet size among the EV customers are larger.
Okay, interesting. Okay, you've got lots of different customers out there as well. So, how's the sort of CCS and sort of carbon credits side of things of evolving? Do you see that continuing to grow? We've seen a fall off of interest and a fall off of a number of companies, looking at kind of carbon credits in the public markets. How are you getting on?
Yeah, a few things. Fundamentally, we believe that carbon credits as well as CCS are good tools in the toolbox to help an energy transition. So the idea of capturing CO2 and store it safely in the reservoirs where it came from is part of the solution. The idea of creating a market for low carbon options by allowing to trade credits around it is sound. So then you end up in the details, and in the details it quickly gets more complicated. We have reached the conclusion that on nature-based solutions, the SHEL brand is not helping the brand of nature-based solutions. So maybe 5 years ago, we had an idea that that could become a major new business for SHEL, and we are not there any longer. Simply, we don't think we help nature-based solution projects by being a major energy company involved in it. But we do continue to trade credits, and we do continue in our biofuel assets to benefit from the carbon credit market. On CCS, the technology has existed for decades. It used to be called enhanced oil recovery, where you took the gas that you didn't have an outlet for and put it back into the reservoir to produce more oil. So it's a technology we and our peers all master. And the problem here is again cost. So the economic incentive to install it, what we see in markets where CCS is taking place is that the government have come in and either supported building these by funding or created tax incentive for these projects to go ahead.
I mean, it's interesting. Like big companies evolving and changing, as you said right from the outset. It takes time to kind of change the direction of the tanker. Pardon the pun. Because there's so many moving parts. There's so many people. There's a lot of in terms of strategies, getting everyone on board, cultural change, opening new markets, all this stuff that just takes time to do properly. No problem with that. But do you find that it's easier to kind of focus on the kind of like the wholesale market rather than try and talk about, these sort of, I guess, the retail side of things where you're looking at data management and trying to increase the size of the wallets or access to more, people get to be able to spend more. I mean, the core of the business is big business, and then sort of dropping down into this, we're going to be an ethical, and player, and a kind of retail access, data management. Is there again a sort of trade-off there between what's the most efficient use of your time and most efficient return on all of that effort? Would you feel it's incumbent on you to be this kind of holistic, all-encompassing company with all these kind of different customer touch points?
No, it's driven by commerciality. So it's driven where we have that competitive advantage, where we have the assets, and you're right. Predominantly, that's a B2B business. In our upstream business, very much producing oil. Our LNG business, you don't have more than a few hundred customers in LNG. And then you have the downstream business, not least in mobility, which is a quite asset-heavy business. And there's quite a lot of assets, but you're right, there's a lot of customers. And that's how we have always been. It has given us some trading advantages, that integrated value chain and the margins you can capture on each step, as we have discussed. And that's why we are what we are. We think that in the energy transition that is happening, we are in good place because we are producing the right oil. We think LNG is going to be a winner in the energy transition because it's simply better than coal and oil. And we think that proximity, the close connection to our customers, give us advantages in mobility in terms of EV, but also in terms of trading energy solutions with our customers. So, and that's our B2B customers. So we have made experiments around, could we become B2C provider of power? And we have given up on that. So we are a B2B business outside the marketing business, lubricants and mobility.
So, and how much of, because there's a lot of moving parts. I mean, how, if I look at some of your, say, some of the joint ventures, Equinor and Pavilion Energy, and those sorts of companies, is there a kind of like head office culture and then a kind of outsource manage, share financial risk model, which probably works better for you? Or do you like to actually have, ownership of all of these divisions, all these vertical departments within this quite large company of yours? What's the most efficient way of doing it? Are you changing or shaping your opinion based on some of the joint venture or outsourcing models?
Yeah, a little bit of horses for courses. Again, I don't think there's a general rule. It's based on specific circumstances in specific markets. What are the operating model where that is providing the best yield, and that can be own operated, and sometimes we're keen to go in and take that operatorship, and it can be operated through joint ventures. It can be that we are a shareholder in a venture with a good operator that is operating for us, and all of these can work for us. So there is not one model. We talked about it when we looked at the mobility, the service stations. So we can be flexible, but when we talk culture, then it's far more important that we have a more commercial set of priorities than we maybe have had in the past, that we're very clear of what is it we are trying to do. We came from having over 70 targets to having 4 financial targets and 4 targets on less emissions. And that clarity that gives to everybody, this is what is important, is something that the current management team have worked on, where we see progress being made. So when we talk culture change, is more that than we are going for one operating model that will suit everybody. The operating model will be a decision that depends on the specific circumstances in the specific markets, including, and can be including, is there a model where you have very mature assets and you make a joint venture with somebody who has very immature assets, and together you get a profile that is allowing you more efficiency, as an example. These kind of things we hope.
Actually, I can ask you, what's Shell's view on nuclear? It seems to have garnered a green tag in the last 4 years, like primarily because Belarus energy costs across Europe were soaring, and the US were soaring, and nuclear has come back into fashion. We're seeing, the US cross-party agreement that nuclear is A-OK again with American markets, and very little, if any, pushback from consumers. So it's a small market, the nuclear. It's an uranium that feeds it, and enrichment. Is that in the mix? Has it been discussed, or as an energy solution that's off the table?
Yeah, two different answers. I think from an energy system point of view, it's an energy solution that is clearly in the mix, as you also highlight yourself. Uh, Today, Shell don't see us having competitive advantages because we haven't been in that business. So it's not something we are pursuing. Again, we don't need to be part of the energy system. We should focus on the areas where we have the competitive advantages, where we know more than others, and today that's not in nuclear.
Okay. And with regards to, straight answer, with regards to breaking into new markets or expanding the share of wallet in sort of weaker, is in markets with kind of weaker infrastructure or unstable regulation, is that something that you would look at?
Say more, sorry, Matt.
So I'm just saying, in terms of the growth, you got to talk a growth story, and you do, and you want to be profitable in those markets, but there will be opportunities still in jurisdictions which have kind of weak infrastructure, which aren't kind of set up at this early stage entry, or perhaps other people don't want to go there because there's such unstable kind of regulation around it. So how do you feel about that kind of growth into markets like that?
Yeah, fundamentally, we have, of course, operated across the world in some developing countries that haven't been the most stable of all, and that is part of the oil and gas sector because some of the oil have been or gas have been found in those countries and have been developed in those countries. So we have a good idea of what it takes to go into such countries and operate in such countries. So I don't think that's a blocker in its own right. If anything, you could say that that's something we, as a sector, should be fairly used to. So then it's back to, so what is it we add? What is it that why are we the right company to go into such a market? What is it that we can generate that other companies cannot generate in terms of margins and profit? And if we don't see that, then I don't think we would go in just because it's a developing opportunity. So again, it has to be then linked into something where it's very clear that here is a fundamental opportunity for Shell that is somewhat limited compared to anybody else because of XYZ.
Okay, let's talk about shareholder return policy. You're talking about like 40-50% of cash flow from operations. That's impressive. But you're also sitting with a big chunk of debt on the books. So again, what's the attitude in terms of these sort of cleaning up the balance sheet, and are you under pressure to return that amount to shareholders, do you feel?
A couple of things. We have a very healthy balance sheet, a very strong balance sheet, and we have been good in terms of capital discipline in recent years, and with that have been able to bring down our net debt. We have quite a lot of leases, so and that's linked to not least our LNG business, but also some of our trading business and also some of the retail businesses where we have leases. So our net debt is just about $40 billion this quarter, just over $40 billion. But net debt without leases is around $10 billion. So we actually have a very strong balance sheet. And we like that, and we like the way we have been disciplined in good times by bringing down debt, but also by increasing the share buybacks. And we have now, over the last 14 consecutive quarters, distributed more than 3 billion or more back in share buybacks, which means that the share count has been reduced by 22%. If we continue at that rate in a macro environment with an oil price around the $70 in today's prices, then you can do additional up to 40% of that. which means overall you would have reduced the share count by 50%. That's historic. Nobody have done that before in Shell's 100 years history. And you can say we have the disadvantage compared to our US peers that our valuation is lower than theirs. What they can do is they can do large M&A, and they can use their share price to finance that. We don't have that luxury because we don't have that strong evaluation. What we have is, though, we have the opportunity to buy back our shares, our own shares, at a low price. And that's exactly what we're doing.
Okay, so cash buyback, sorry, share buyback, good. Distributions, good. You've obviously been lowering your capex, or you're certainly forecasting to continue to lower your capex significantly. But at the end of the day, this is going to be growth through driving revenues. How much of the business is completely dependent on the price of oil, and how much is going to come from sort of new energy growth?
Yes, we have enhanced the capital discipline. We have, over the last 20 years, been poor capital allocators. And management have found it extremely important to address that. And the way to do that is to increase the competition within the company for capital and make sure that we become better at using our commercial muscles, plus being better at being very disciplined when we approve and select projects. So that's one side. With that, we see that the efficiency in the way that each dollar is spent have increased as well. So it's, we are getting more out of each dollar we invest. So that's on the cash CapEx side. It comes through to some degree also on the OpEx side, where we have lowered our OpEx, and we see structural OpEx saving of $5 to $8 billion between 2022 and 2028. Again, simplifying the company and becoming more competitive. And even if we deliver the $8 billion, we will still not beat first quartile on cost. So in that sense, you can say we are blessed by being fat, meaning that there is quite a lot of OpEx we should be able to take out of the organization. So there is some significant cash flow upsides in terms of discipline in CapEx and OpEx. Now then you ask about oil price volatility, and there we have shared that we have very good break-even cost in terms of up to over 1 million barrels a day that we will add between now and 2030, with an average break-even cost of $35 per barrel. So very good. Secondly, compared to our peers, we have a larger downstream business and trading business, which by and large is independent of oil price. So we are actually more resilient to lower oil price than our peers. So a lot of self-help, a lot of structural hedge towards a lower oil price.
Right, and what about the sort of internal? I'd like the comment about internal competition for budget. What's the kind of minimum hurdle rate that you look for before you would consider backing a project, new project?
Yeah, they currently sit slightly different for the businesses. In upstream, it's an IR of 15%. The rationale behind that is that you have quite a lot of sunk cost when you do a seismic campaign and it's negative, or you do an exploration well and it's negative, which is part of the business. In LNG, it's around 11%. In the traditional marketing businesses, including EV, it's at 15% again, and in power, it's at 10%, and in low carbon fuels at 10%. and that's because of the growth potential in those businesses.
Yeah, I guess there's a bit of pressure there in the sense that you can't be seen to be sort of gouging the market in the good times, because I think you get a lot of kind of regulatory oversight from governments in the countries that you operate as well. But it sounds like your investors are happy with that sort of margin.
Weighted average cost of capital of 8.5%. So we definitely need to beat that to be creating value. Historically, again, we have struggled to do that. So is it reasonable that there is a evaluation gap between Chevron, Exxon, and Shell? Yeah, if you look at it over the last 20 years, for example, Exxon have done a really good job being capital allocator. We have not. We have fixed that over the last 2 years, but does it take more than 2 years to build that trust? Yeah, we accept that it probably does. And that's again why you saw the Capital Market Day being back to where we started this conversation. Not a revolution, but an evolution. The medicine is working. The patient shell is out of intensive care. But we are not in Olympic shape. We are not firing on all cylinders. There's more to be carved out in terms of value, and therefore we continue to do exactly that. But as we do that, we have also increased the distribution to shareholders such that they get a fair share of that positive development as we continue to deliver that.
Andreas, thank you very much for your time today. Really good update. Nice to see the conviction to carry on and focus on, like I said, the commercial realities of the markets at the moment. I mean, in fact, final words from you. I mean, how do you read the kind of macro situation for energy? It seems like a lot of unknowns with tariffs, war still raging. How does it affect your business decision making, or do you look beyond, I guess, government terms? The year, Trump will be gone in 3 years. We're on to the next thing. Europe seems to be, all change as well. Do you have to plan for longer periods of time? I mean, or do you have to pay attention to the short term vagaries of the politics?
Yeah, and of course both are right, and it's also fair to say if I knew I wouldn't work in investor relation in Shell, I would be probably a very wealthy man somewhere else. So of course we don't know, but in many ways we do know that the sector is cyclical, has always been, and will always continue to be, because supply and demand is not coming in nice, smooth, consistent flows. It comes in steps, and there's changes in terms of growth in the world, which essentially is what controls the demand side. But there is also policy changes in countries, including OPEC, that means that supply can go up and down, and we are not in control of that. So the fundamental answer is we can't control it. What we can do is we can prepare ourselves for it. And that's exactly what we have done the last 2.5 years, by making sure we have enhanced the discipline. We've simplified the company, and we have improved the balance sheet. So we are ready for a more difficult market, and that's what we've worked for, because we didn't know when it will come, but we did know that sooner or later it would come. So we are a company that is far more resilient than a few years ago. We are a company that now openly share that there's a lot of longevity in terms of opportunities in this company, and from that perspective we can look at all the uncertainty with a level of satisfaction in terms of how far we have come, without losing track on that there is so much more we can do with this company to get it in that Olympic form and shape that we aspire to.